Hello everyone, I'm John with JP Strategic Investments, and today we're going to talk about the huge move that we're seeing from Rocket stock. First of all, I want to say congrats to all of you Rocket investors out there. This is something that we've been waiting on for a long time, and it sure has been frustrating to watch the stock do almost nothing for months, but we're finally getting rewarded. Today I'm going to talk about what I think exactly is driving this move, whether it's shorts covering or Wall Street bets or anything else, and how far I think this move could eventually go. Leave me a comment below if you're a longtime Rocket investor like myself, and with that said, let's dive right in. So obviously Rocket stock had a huge move today, closing up 71% at just over $41 per share. And this comes just after the stock was up almost 25% in the previous 2 days. Now, obviously all of this is coming right after Rocket reported some stellar earnings last week. And by the way, if you're new to the stock, I also did an entire video on my analysis of that earnings report, so definitely go check that out if you really want to understand what the catalysts are driving this stock. So with that said, I think there are two main types of traders pushing the stock right now, and those are shorts and momentum traders. And to take it even further, I think a lot of the shorts are not only just covering, but actually moving into net long positions. Let me explain why. So for anyone that has held Rocket stock over the past several months, they've experienced firsthand the type of manipulation that short selling can cause. Every time that Rocket stock started to gain momentum and move into the mid-20s, it would almost immediately be pushed right back down to where it was trading before. This can obviously be extremely frustrating for investors who own the stock. Now, one thing that hedge funds and institutional investors often do is have both long and short positions in a stock. This way they can kill the momentum in the stock by selling short and then add to their position at a discount as other traders continue to sell. This was exactly what was happening with Rocket stock over the past several months. Hedge funds and institutions were accumulating shares while holding the stock down by selling short. But then recently something interesting started to happen, which I touched on in my earnings prediction video. All of a sudden, we started to see several 13G filings showing increased ownership from several different institutions. This tells me that the institutions were repositioning themselves to be net long on the stock. Personally, I think there are several more hedge funds and institutions that are scrambling to do that right now. And this, of course, is where the momentum traders come in, and that includes institutions as well as Reddit traders looking to target the next short squeeze. Now, don't get me wrong, I don't think this is going to be a GameStop situation. But that being said, we all know that when more momentum traders jump into a stock, the stock starts to go higher and more shorts are forced to cover. But because we don't know exactly how many momentum traders will jump in and how many shorts will be forced to cover, it's hard to figure out exactly how far this squeeze will go. I think the smartest thing to do in this case is to determine where you think the fair value of Rocket stock is. Once you determine that, if the stock is below that value, it's pretty easy to make an argument to hold on. If the stock gets above that value though, then it's probably time to start thinking about taking profits or at least hedging your position. Personally, I think Rocket should trade at least a PE of 15, so I'm looking for the stock to be somewhere between $60 and $65 per share. That's still about a 50 to 60% increase from where the stock is currently trading at $41. Now that being said, obviously stocks can be very unpredictable in these types of situations, so it's understandable that investors might want to err on the side of caution. So let's go over a couple of ways that you could hedge your position without putting too much of a limit on your possible gains. Personally, I don't like buying puts in these types of situations because the premium can be very expensive and can cut into your gains, but obviously this is an option. Another thing you could do is sell covered calls. Now, you do have to have at least 100 shares to sell covered calls, but for any of you out there with 100 shares or more, this is a great option. Covered calls allow you to not only hedge your position, but possibly make some extra income if the stock continues to rise. The other nice thing about selling calls in these situations is that the high premium works to your benefit. For example, right now with Rocket, you could sell a $50 call that expires on March 19th for $700. That means that if you owe 100 shares, if the stock dropped from 41 to 34 by March 19th, you wouldn't lose any money. Plus, even if the stock shot up another 30%, you would still get all of those gains. Finally, one last thing you could do is sell cash secured puts. I'm sure a lot of you guys would probably pick up some more shares at the $20 or $22 level if the stock all of a sudden dipped back down. Well, if you would do that anyway, it's almost a no-brainer to sell a few of those puts to make the premium if the stock continues to rise. But like anything in the stock market, regardless of whatever strategy you choose, make sure you know exactly what you're getting into before you make any trades. I hope you found this analysis helpful, and if you did, please consider liking and subscribing. Also, don't forget to leave me a comment below if you're a fellow Rocket investor or if you have any questions. Other than that, see you next time and have a great day.